Welcome back, my friends. Carvana on Thursday said it expects to achieve positive adjusted earnings during the second quarter of this year, earlier than previously stated. The embattled used car retailer has been working to reduce costs, narrow losses and increase profits per vehicle. The company's stock fell roughly 98% last year. Carvana has been weakening financially for a few quarters now. And they have never been profitable. Sounds like the situation with a lot of tech unicorns, doesn't it? If you follow this channel, you already know that Carvana has basically been a slow-motion train wreck. But things may be starting to look up. So, what is the real future of Carvana? What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. For those of you not familiar, Carvana is an online platform for buying and selling used cars. Founded in 2012, Carvana has revolutionized the way people purchase vehicles by offering a completely online and convenient process. Customers can browse through thousands of cars on the Carvana website, purchase the vehicle they want, and have it delivered directly to their doorstep. One of the most unique features of Carvana is its car vending machines. These are tall glass towers located in various cities across the United States where customers can pick up their newly purchased car in a fun and memorable way. The process involves the customer entering a special code, the tower retrieving the car from the tower and then bringing it down to the ground level for the customer to take ownership. Carvana's business model eliminates the need for traditional car dealerships, which can be time-consuming and frustrating for many customers. Carvana's website offers detailed descriptions, high-quality photos, and even 360-degree virtual tours of every car on the site. Plus, the company offers a 7-day money-back guarantee, which gives customers peace of mind when purchasing a car online. Overall, Carvana has gained popularity in recent years as a user-friendly and innovative way to purchase a used car online, without the hassle of dealing with a traditional dealership. Shares in Carvana surged 40% after company says it will achieve adjusted profits sooner than expected. Carvana on Thursday said it expects to achieve positive adjusted earnings during the second quarter of this year, earlier than many anticipated, as the used car retailer executes a restructuring focused on cost-cutting and profits over growth. The stock was up about 40% in early trading Friday to roughly $10 a share. Carvana closed Thursday at $7.20 per share. The company, which pre-announced first quarter results in March, beat Wall Street's expectations for adjusted losses per share, recording a loss of $1.51 per share, versus consensus estimates of $2. Revenue of $2.61 billion came in exactly in line with projections. The embattled used car retailer has been working to reduce costs, narrow losses and increase profits per vehicle. The company's stock fell roughly 98% last year as it overspent to gain sales and increase vehicle inventory amid weakening demand. Carvana said Thursday it achieved a previously announced reduction in selling, general and administrative expenses of $1 billion a quarter early. The company last year announced plans to achieve a positive adjusted EBITDA this year, however pulled that guidance due to current industry and macroeconomic conditions. Carvana last reported a positive adjusted EBITDA of $20 million during the third quarter of 2021. The first quarter was a big step in the right direction and there are more steps to come. Given our strong start to the year, we expect to achieve positive adjusted EBITDA in Q2 2023, Carvana CEO Ernie Garcia said in an earnings release. It is clear our strategy and execution are working as evidenced by our 61% increase in gross profit per unit, the best first quarter GPU in company history. Wall Street was watching for additional steps in the restructuring of the company as well as improvements in total gross profit per unit, specifically. GPU was $4,303, an increase of 52% compared to the first quarter of 2022. Sales also came in ahead of expectations, at 79,240 units, compared with a previously stated forecast of between 76,000 and 79,000 units. Sales during the same quarter last year were 105,000 units. For the first quarter, Carvana reported a net loss of $286 million, down from a loss of $506 million a year earlier. On an adjusted basis, the company lost $24 million, down from a loss of $348 million a year earlier and narrower than its $291 million loss during the fourth quarter. "I think we've proven that we can do much better than we ever have in the past," Garcia said Thursday on a call with investors. Carvana was a coveted stock during the COVID pandemic, as consumers moved toward online car purchasing and the used vehicle market skyrocketed due to a lack of inventory of new vehicles. But the company failed to capitalize at the right time and launched the restructuring of the business. Carvana was founded in 2012 by Ernie Garcia, Ryan Keaton, and Ben Houston, who wanted to disrupt the traditional car buying experience and make it more convenient and transparent. The idea for Carvana came about after Garcia, who had been working in the automotive industry, realized that there was a need for a better way to buy cars. In its early years, Carvana operated in just a few markets, including Atlanta and Nashville. The company's business model involved buying used cars from auctions and individual sellers, reconditioning them, and then selling them online to consumers. One of Carvana's most distinctive features is its car vending machines. The first vending machine was built in Nashville in 2015 and allowed customers to pick up their purchased vehicle in a unique and memorable way. Carvana has since expanded this concept to other cities, including Houston, Dallas, and Tempe. Over the years, Carvana has continued to expand its offerings and services. In 2017, the company went public, raising $225 million in its initial public offering. Since then, Carvana has become one of the fastest-growing companies in the automotive industry, with revenue growing from $365 million in 2016 to $5.6 billion in 2020. Today, Carvana operates in more than 270 markets across the United States and offers a wide variety of services, including car sales, financing, trade-ins, and delivery. The company has become known for its user-friendly website, transparent pricing, and commitment to customer satisfaction. Carvana's creditors include some very big names: Apollo Global Management, Pacific Investment Management, also known as PIMCO. The big holders have about $4 billion of Carvana's unsecured debt. Shares in Carvana fell by more than 98% since their all-time high. You may already know that Carvana stock peaked at $376.83 per share on August 10, 2021. Carvana has received downgrades from many Wall Street analysts. Carvana grew exponentially during the coronavirus pandemic. At that time, car shoppers shifted to online purchasing, even for cars. It was seen as safer than visiting a dealership in person. Carvana also promoted hassle-free buying and selling of used vehicles from the comfort of home. But Carvana did not have enough cars to meet the surge in consumer demand. Nor did it have the right facilities and workers to process the vehicles that it did have in stock. So then Carvana bought car auction company Adisa from Car Global. Carvana also bought a record number of vehicles at what turned out to be sky-high prices. But government stimulus during the pandemic caused inflation to rage almost everywhere. The Federal Reserve responded by aggressively raising interest rates. That caused car buying demand to slow dramatically. On top of that, fears of a recession set in. That made car buyers cautious and slowed Carvana's sales. Carvana could not react fast enough to the rapidly changing macroeconomic environment. So the company repeatedly borrowed money to cover its losses and various growth initiatives. That included the $2.2 billion acquisition of car auction company Adisa. Morgan Stanley analyst Adam Jonas pulled his rating and price target for Carvana stock. Jonas cited a number of factors: deterioration in the used car market, sky-high debt, and a volatile funding environment. Jonas also said that Carvana stock could be worth as little as $1 per share. Car pricing and profits soared during the coronavirus pandemic. Investment bank Morgan Stanley pulled its rating and price target on Carvana and will not even give another target. That is a bad sign when that happens. And, you know the financial and economic narrative of the times. Inflation is raging in most parts of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers' budgets are getting tighter because of having to spend more on gas and food. So, consumer discretionary spending is weakening. This year, it is clear that Wall Street analysts are valuing profitability over prospective growth. As a result, unprofitable tech companies' shares are getting punished. It seems that the day of reckoning for tech unicorns has arrived. And all companies are forced to either be profitable, find a merge partner, or die. The window for initial public offerings is effectively closed. That is why some Wall Street investment bankers are predicting a wave of tech mergers later this year. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.